Hello, I'm Asif Farouk of Finextra, and we're here with Tim Lind, Global Head of Financial Regulatory Solutions at Thomson Reuters. Tim, let's talk about the data regulatory challenge. How do you see regulations impacting operations, specifically the data management function?
Well, we're finding now that time for debating the merits of regulation are over, and we're on to the practical implementation of these regulations. Challenge for data management, we're filtering through thousands of pages of text and trying to translate this text into actual specifications. So regulations mean disclosure. Disclosure requires templates. We have to fill these templates with very specific information so regulators can make sense of it. So we're translating our investment portfolios into these templates require codes. In the data management function, we can't afford ambiguity. The challenge is there's no help desk. There's no user guide that helps our clients translate these requirements into these templates. And so that's where we come in, and that's where the big challenge for data management is. We're tracking 4 different types of regulations, again, mostly around disclosure and transparency. Dodd-Frank and EMIR, how do we disclose swap positions and transactions, value of those swaps, to clearinghouses, to swap data repositories. So that's the first one. Second one, better transparency in the alternative investment space. So how do hedge funds disclose their investments, their performance? AIFMD, the Alternative Investment Fund Managers Directive in Europe, and the United States, we have Form PF. So again, disclosure of investments into a template. The third involves taxation. FATCA in the US, which we think only the beginning of governments chasing their citizens abroad in order to claim taxes back and tax liabilities. So FATCA, and what we're thinking of the sons of FATCA, other legislation in countries. Also transaction taxes. Italy, France, for example, and the EU continues to debate transaction taxes across the whole Commission. So tax liability for certain securities. So those are the main regulations that we see impacting classification of securities and data management. I'd say the fourth, which brings us to one of the big focuses, how do we calculate the solvency and capital adequacy of the positions that we have? Basel III in the banking world, Solvency II in the insurance world. Do we have adequate capital, adequate solvency in our portfolios to meet the demands of our policyholders in insurance, or to protect ourselves against the default of a counterparty in the banking context?
So you've touched on FATCA just there. What are some of the latest developments with it?
So on February 20, the IRS issued what we believe to be the final guidance leading up to the first phase of implementation on July 1st. The challenge that we've had around FATCA, especially in the data management world, is how we classify U.S. securities as being eligible for a tax. So it's fairly straightforward to say this security came from a U.S. issuer. It's fairly straightforward to determine whether or not that debt is grandfathered, and FATCA provides for certain exemptions of withholding for an outstanding debt. That's called grandfathered obligation. That's all fairly straightforward. The challenge is that grandfathered obligation can be removed if there's what they call a material modification to the debt. The challenge is the statute is filled with ambiguous language. For the issuer needs to have a reason to know that that change in the debt constitutes a material modification, and a withholding agent has to have actual knowledge of that change. The problem is the IRS doesn't tell you what actual knowledge means or what reason to know. So the industries associations in the US had petitioned the IRS to say, we want you to say an issuer has to provide a written statement that this change is a material modification pursuant to FATCA. Unfortunately, that was not provided in the most recent guidance, so there's still a ton of ambiguity in how withholding agents will determine any change and whether or not that change will cause them to withhold or remove this grandfathered obligation flag. Unfortunately, the process will not be automated. We think that every change will require some type of tax opinion, expert opinion. So unfortunately, automation and the whole exchange of data for this is going to be a manual process.
And what are some of the other regulations that you're actively investigating, and what potential data requirements are involved?
Well, there's a lot of different facets of FATCA, and I mentioned grandfather obligation and the data side of it. In addition to that, we're looking at other aspects. How do we screen accounts and whether or not those accounts have a connection to a U.S. entity, power of attorney, social security numbers from the U.S., etc. Identifying those accounts, screening those accounts, remediating those accounts. We have workflow tools that look at that process, the electronic filing of tax reports, etc. So it's beyond just a data management, but a workflow and screening tools, etc. So FATCA is pretty encompassing for us. There's two others that we're really focused on. Solvency II, I mentioned before. There are really four aspects of Solvency II. So there's provision of listed pricing, of evaluated pricing on OTC instruments and thinly traded instruments. There's a lot of reference data required in a quarterly reporting template under Solvency II. New classifications, a CIC code which identifies the asset class and origin of a security, a NACE code which identifies the industrial sector of a security. So the security information, the classification, grows with each new disclosure template. Our clients have to onboard this information and provide this in a Solvency II disclosure. So that's driving our content roadmap. The other aspect of things like what we call a credit quality step, which is the amalgam of credit agency ratings, bringing those agencies' ratings together and creating an algorithm to basically create a composite rating. There's a method and process within Solvency II to do that. So all this information is required in this Pillar 3 of Solvency II in a disclosure template. Clients need extra classification and pricing data, and that's what we're looking to provide. The third aspect we're really focused on this year is the obligation of asset managers to provide significant shareholder reporting. Every buy-side firm that breaches a threshold of ownership needs to report to national regulators, make a statement that they've breached that threshold. Industries like finance, natural resources, telecoms, etc., sensitive industries are typically tracked. So if you own more than the outstanding share capital, more than 10%, for example, or voting rights of a company, you need to report that to the regulators. Regulators are increasingly draconian in terms of enforcing these reports. Every country is different in terms of how the percentage is calculated. What source do the asset manager rely on in order to determine outstanding share capital? Does that outstanding number include treasury shares or not? So it's a very difficult process, and there's high stakes if you get it wrong. So that's another area that we're looking at in the portfolio compliance space. So those are really the priorities for us in 2014.